In July 2025, optimism filled the Oval Office. The air was thick with anticipation, as if history itself was about to be written within those storied walls. Advisors whispered in corners, journalists waited outside, and the world watched, eager for a breakthrough. As President Trump and South Korean President Lee Jae-myung shook hands, cameras captured the moment, signaling what was hailed as a new era in U.S.-Korea relations. The handshake was more than a gesture. It was a carefully choreographed message to allies and rivals alike. The $350 billion agreement was the result of months of negotiation, late-night calls, and tense meetings. It promised South Korean investment in American industries, a reduction in U.S. tariffs, and the hope of revitalized trade between two economic powerhouses. For Trump, it was a political win, proof of his America First trade strategy. He touted the deal as a triumph, a validation of his approach to international diplomacy and economic policy. For Lee, it was a lifeline to ease the 25% tariffs crippling South Korea's exports. The agreement offered hope to struggling manufacturers back home and a chance to stabilize his own political standing. Both leaders touted the deal as a win-win, but the details were vague and the mechanisms unresolved. Behind the smiles, aides on both sides worried about the fine print and the challenges that lay ahead. The handshake was a symbol, not a solution. It represented hope, but also uncertainty. A promise that would need to be tested in the months to come. As the cameras flashed, the world saw unity, but behind closed doors, the real work was just beginning. Negotiators braced for the difficult task of turning broad promises into concrete action. The euphoria faded quickly as the enormity and complexity of the deal became clear. Every clause, every commitment was scrutinized by teams of lawyers and economists. The path from handshake to implementation would prove far more treacherous than either leader anticipated. Disagreements surfaced, deadlines slipped, and the initial optimism gave way to frustration. The promise of July would soon collide with the harsh realities of October. As summer faded, so did the sense of certainty that once filled the Oval Office. The stage was set for a test of political will and economic survival, a test that would demand more than handshakes and headlines, but real solutions to complex problems. The U.S. saw the deal as a direct boost to its economy. $350 billion in foreign investment, a staggering sum that promised to ripple through every sector. It meant new factories rising from the ground, bustling with activity, and thousands of American jobs created almost overnight. Trump's team envisioned capital flowing into manufacturing, technology, and infrastructure, sectors they believed would restore American strength and competitiveness. Their goal was clear: shrink the trade deficit with South Korea and reassert U.S. dominance in global trade. In return, the U.S. would lower tariffs from 25% to 15%, a significant cut that would make Korean goods more competitive on American shelves and in showrooms. For South Korea, the deal was about survival. Tariffs had battered its export giants like Hyundai and Samsung, threatening jobs and economic stability at home. Lee's government planned to structure the $350 billion as a carefully managed package. Loans, guarantees, and equity stakes spread over several years. It wasn't a blank check, but a strategic investment designed to protect Korea's interests. The vision, at least on paper, was mutual benefit. Korea would invest, and America would open its market in return. Both sides would win, or so it seemed. But beneath the surface, expectations diverged. The U.S. wanted immediate, concrete results: factories built, jobs filled, and money flowing fast. Korea, on the other hand, sought a gradual, strategic partnership, with careful oversight and long-term planning. The two sides could agree on the headline numbers, but when it came to the fine print, their visions clashed. The gap between their ambitions and their realities would soon become a chasm, threatening the entire pact. What looked like a partnership on the surface was, in reality, two very different deals. Each side seeing what it wanted to see. The seeds of conflict were sown in the details, hidden in the language of contracts and the assumptions of negotiators. The stage was set for a major misunderstanding, one that would shape the fate of the $350 billion pact. The deal unraveled dramatically when the U.S. delegation, led by Commerce Secretary Howard Lutnick, stunned the room by demanding the entire $350 billion as an upfront cash payment. This was not a request for a phased investment or a gradual transfer. Washington wanted the full amount in cash, before any agreement would be signed. The demand sent shockwaves through Seoul's negotiating team, who had never anticipated wiring such a colossal sum directly from the national treasury. The sheer scale and immediacy of the request left Korean officials reeling, unsure how to respond to such an unprecedented ultimatum. For the Americans, this was about certainty and control. Cash in hand meant no risk, no waiting, and no chance of future disputes over payment schedules or investment milestones. Washington's position was clear. Only a direct, immediate transfer would count as a real deal. Anything less was seen as unreliable, a potential loophole for future disagreements. This demand transformed what was supposed to be a partnership into something that felt more like a penalty or a ransom, fundamentally altering the spirit of the negotiations. South Korea's negotiators were blindsided. Their carefully prepared plan had been for phased, strategic investments, measured steps that would benefit both economies over time, not a single massive outflow. The U.S. pointed to Japan's recent deal as a precedent, arguing that Korea should comply with similar terms. They insisted that if Japan could agree to such conditions, so could Korea. The two sides were now deadlocked, each accusing the other of acting in bad faith. Tensions rose as both delegations dug in, unwilling to yield. The handshake of July, once a symbol of hope and cooperation, now seemed like a distant memory, replaced by mistrust and suspicion. At the heart of the dispute was a fundamental question. Was this supposed to be a long-term investment, or simply a massive one-time payment? For the U.S., the answer was simple. Cash now, no exceptions, no delays. For Korea, the vision was different. A long-term partnership, built on trust, shared goals, and gradual investment. The impasse threatened to destroy the entire pact, as both sides began to question whether any agreement was possible. Negotiations ground to a halt, the once promising talks now mired in silence and frustration. The future of the deal hung by a thread, with both nations facing the real possibility of walking away empty-handed. Seoul warned that a $350 billion cash payment would devastate its economy. South Korea's foreign reserves totaled just $410 billion. Paying the U.S. would wipe out 85% overnight. These reserves stabilize the won and pay for vital imports. Losing them would risk a currency collapse. President Lee compared the threat to the 1997 Asian financial crisis, a national trauma. A sudden outflow would crash the won, spike inflation, and trigger bankruptcies. The government pleaded for a compromise, a currency swap line with the U.S. Federal Reserve as a safety net. But with talks stalled, Washington refused. Korea faced an impossible choice: economic ruin or crippling tariffs. The U.S. offered no lifeline, only demands. The stakes were existential for Seoul. The deal, once a symbol of partnership, now threatened disaster. The crisis deepened with every passing day. Korea was trapped between a rock and a hard place. The world watched as the alliance teetered on the brink. The cost of failure was becoming painfully clear. The U.S. pointed to its $550 billion deal with Japan as proof Korea could comply. But Japan's economy is far larger, with $1.3 trillion in reserves, 3 times Korea's. For Japan, the payment was manageable. For Korea, it was catastrophic. The yen is a global reserve currency, giving Japan stability Korea lacks. Korea's reserves are limited, and its won is far more vulnerable. The U.S. failed to see these differences, applying a one-size-fits-all approach. What worked for Japan would break Korea. The comparison was not just flawed, it was dangerous. The U.S. risked pushing a key ally into crisis by ignoring economic reality. The Japan model simply didn't fit. In September 2025, U.S. immigration agents raided a Hyundai LG plant in Georgia, detaining hundreds of South Korean workers. The timing was disastrous, just after President Lee's White House visit. The raid outraged Koreans, fueling anger over the trade talks. The image of Korean workers detained on U.S. soil shattered trust. Public opinion in Korea hardened. Concessions to the U.S. became politically toxic. Apologies from Washington did little to calm the backlash. The incident turned a trade dispute into a matter of national pride. Negotiations grew even more fraught. The alliance was shaken, and compromise became nearly impossible. The rift between the two countries deepened. As the US-Korea talks stalled, Canada and the EU moved quickly to secure their own trade deals with Washington. They learned from Korea's struggles, opting for flexibility and pragmatism. Canada struck a new agreement, avoiding the pitfalls that trapped Seoul. The EU also made progress, sidestepping all-or-nothing demands. These deals left Korea isolated, watching competitors gain US market access. The message was clear: the US would deal, but only on its terms. Korea's bargaining position weakened as others moved ahead. The world wasn't waiting for Seoul to resolve its crisis. The pressure on Korea mounted, the cost of delay was growing by the day. The upcoming APEC summit in Seoul is now the last, best chance to save the deal. President Lee must convince Trump to drop the cash demand and accept a phased investment plan. The stakes are enormous: economic survival for Korea, a legacy-defining win for Trump. Both leaders face intense pressure. Failure could fracture the alliance and shake global markets. Lee needs a breakthrough he can sell at home. Trump wants a deal that proves his negotiating prowess. Will they find a creative compromise, or will the talks collapse? The world will be watching as the two leaders face off. The outcome will shape the future of US-Korea relations and global trade. The summit is no longer routine. It's the final arena for a high-stakes showdown. The fate of the deal, and much more, hangs in the balance. The US-Korea trade deal is more than an economic pact. It's a test of global trade in the America First era. If it fails over a cash demand, it signals a shift to transactional, one-sided deals. The fallout could weaken a vital security alliance in East Asia, risking regional stability. Economic turmoil in Korea would ripple across global markets, disrupting supply chains and investor confidence. The world is watching to see if rules and partnerships still matter. The outcome will set a precedent for future US negotiations. Will trade be about cooperation or raw power? The answer will affect workers, companies, and governments worldwide. The stakes are global, not just bilateral. The resolution of this deal will echo far beyond Washington and Seoul.